Hey folks, welcome back. For those tuning in for the first time, this is a commentary where I basically give you information on some of the latest loan programs or changes to existing loan programs, a recap of the financial markets and what's happening with interest rates, as well as a recap of the local real estate market in Clark County, Southern Nevada. So with you being on the front line, talking with potential home buyers, I try and arm you with good information and talking points that could help you educate your buyers. So I hope you find it informative. So yeah, today I wanted to start with a pretty powerful down payment assistance program that recently rolled out. I believe it's exclusive through Cardinal Financial, but wanted to give you the highlights of the program. It's up to 5% of the sales price, and it can go towards down payment or closing costs. It ends up being a second mortgage spread out over 10 years, and the rate is 2% higher than the start rate of the first mortgage. It's only compatible with FHA, but what I really like about the program is there are no income caps. They don't have to be a first-time home buyer. They can have a FICO score as low as 600, and the rates are really good. They're almost as good as a typical FHA rate, maybe a smidge higher. And then of course the down payment assistance spread over 10 years is 2% higher than the rate on the first mortgage. But typically you'd be looking at, if someone was buying a $400,000 house and they wanted 5% in the form of a loan, the payment would be an extra $225 a month. But certainly it could help the right buyers, ones that have great debt to income ratio, but just don't have that savings saved up. So if you have a customer that you think might fit that profile, by all means, have them reach out. And taking a look at the financial markets, I like to focus on the S&P 500 as a gauge for how stocks are doing in general, and our 401ks for that matter. And I also like to check in and gauge the bond market, where certain mortgage-backed securities are traded, and that's what directly impacts our customers' interest rates. The S&P 500 has been on a tear really since November of 2023, and that's a result of all this positive economic data with job reports. That's really stocks are responding really well to that. It's up. So the S&P 500 index is up 8% for the year in just 4 months. So if it continued on that trend, you would see a 24% increase in just 1 year. It's up 20% from a year ago, and it's up 60% from 5 years ago. Yeah, so you're looking at 12% annual gains in the S&P 500. So the stock market's doing really well. Unfortunately, the bond market is not doing so well. So as a reminder, mortgage-backed securities are traded in the bond market. Our customers' rate that they pay for a mortgage is an investor's rate of return as they buy mortgage-backed securities. So the rates go up in the face of inflation. So with high inflation, there's going to be accompanied with high interest rates. Why? The reason being is the investor's appetite for a mortgage-backed security. The rate of return has to be higher than inflation, or it doesn't make sense to invest in that instrument. That's why you see mortgage rates in the 7s when you have inflation in the 3s and 4s. The rate has to be higher than inflation, or it doesn't make sense. So for the month of April, we saw a couple of damaging reports that adversely affected the bond market. The first was unemployment report or job gain report that basically it came in with more jobs created than the market expected, lower unemployment than the market expected. The reason why this affects mortgage rates is with really low unemployment, it puts pressure on wages. So it forces employers to pay employees more. So wages go up. As wages go up, companies have to raise their prices, and with prices going up, it's direct component of inflation. And then we had the inflation reports that came in hotter than expected. So you have higher than expected inflation rate, higher than expected job growth, lower than expected unemployment rate. And the end result was that mortgage rates just in the last 2 to 3 weeks have the average 30-year fix has gone up by about 0.4%, now averaging at around 7.25%. Other than a couple of months at the end of last year, it's the highest the average 30-year fixed mortgage rate has been in I think 25 years, if you look at the graphs. So it's a rough couple of weeks for mortgage rates. Certainly my fingers are crossed that we start to see some lower rates much sooner than later. Last, I'd just like to gloss over the home sales data for Southern Nevada. It's most of this stuff you guys probably already know, but it's good for me to keep tabs on what's happening with what I call the tide of sales, so to speak. So what we've got at the end of the first quarter being in the books, we can start to draw a picture on what 2024 is going to look like. So from a numbers perspective, I saw 7,770 sales of single family residence, townhomes, and condos for the first 3 months of the first quarter of the year for 2024. That's down about 9.5% from the first quarter of 2023, where there was a little over 8,100 sales. So it's interesting because people always ask, is the market down or is the market up? From a unit perspective, I guess you could say it's down, but the median price home is up. It's up to 465, which is up 9% from March of 2023. It's up 1% from last month. So from a price standpoint, you'd say the market's up. But from a tide standpoint, which is total dollars available in real estate sales, it's flat. The number of transactions is down 10%. The volume or the average priced home is up 10%. So again, hope this is useful. Feel free to share it with your clients, and best of luck this next coming month.